and Urban Affairs will come to order. Welcome the witnesses I will introduce in a moment. This hearing's in a hybrid format. Members have the option to appear either in person or virtually. I think all my colleagues know the rules of that and the procedures. Our speaking order will be as usual, that is by seniority of the members who've checked in before the gavel comes down, either in person or virtually, then by seniority of members arriving later, alternating between Republicans and Democrats. I often begin these hearings by taking us back to 2008 and to the years that followed because we're still living with the fallout. And in the case of the Libor scandal, we're still cleaning up a mess caused by the biggest banks in the world, still cleaning up a mess more than a decade later. As the housing market crashed, more than 8 million workers lost their jobs. Central bankers began to realize just how many markets were broken in the global economy. One of those was the interest rate system. Most people had never heard, maybe still have never heard of Libor. Like so much in the financial system, it's an opaque term for something that affects millions of people's bills and bank accounts and ultimately lives. Libor's been the most widely used interest rate benchmark around the world. It's used to set payments for millions of student loans and mortgages and small business and auto loans. Some $300 billion was tied to Libor at its peak. With that kind of money involved, it should surprise no one that bankers figured out a way to conspire to rig the interest rate to enrich themselves. After the scandal broke in 2012, uncovering the bank's manipulation of Libor, this committee and the federal financial regulators studied the problems and to determine who was at fault. U.S. and foreign regulators imposed billions of dollars in fines on several global banks for manipulating the interest rate and taking advantage of consumers and investors. Now, nearly a decade later, our financial system is finally transitioning away from Libor. Today, we'll consider how the financial system can move on from this benchmark set by a handful of the world's largest banks, a system we found out was ripe for exploitation. Part of that transition involves dealing with trillions of dollars in legacy contracts tied to Libor. That will continue after the rate is discontinued in June of the year after next, after 23. After a slow start, the Federal Reserve Bank of New York and the Federal Reserve Board here, along with industry stakeholders and consumer advocates, have established a path forward. They've developed, as we know, a new, more reliable and transparent benchmark rate called SOFR, the Secured Overnight Financing Rate. They've put forward a framework to address legacy loans and contracts that were written assuming that Libor would always exist. Because Libor is so widely used, homeowners and students who have never heard of Libor will be at risk when it's discontinued if we don't take action. And I'm particularly appreciative of Senator Tester and Elizabeth and the work they're doing, and Senator Tillis also in that. If their loans don't have specific instructions about what happened if Libor disappears, or if their loans give loan servicers the discretion to pick a different rate, those borrowers would be in for a shock. Small and large businesses could be in a similar situation, forced to negotiate a loan tied to Libor at a time when they're just getting back on their feet from the pandemic. Banking agency officials and stakeholders have all said federal legislation would help address those long-term loans and contracts and reduce the potential for time-consuming and costly litigation. Our colleagues on House Financial Services began bipartisan work on a bill that addresses these problems, and as I mentioned, Senators Tester and Tillis are preparing a Senate companion. If done right, this legislation can help borrowers who don't have the ability to bargain with their student loan lenders or their mortgage banker, while also providing certainty to lenders. We know we need to act. I appreciate those efforts by the members of our committee. Under the current proposal, lenders with legacy contracts that don't specify a Libor alternative can transition to SOFR so long as they don't make other changes that could harm borrowers. That would allow them to avoid potentially complicated litigation. It's frustrating. We're forced to spend taxpayers' time and money cleaning up after the biggest banks again and again and again. Unfortunately, if we don't work to mitigate the damage from another big bank scandal, it's always family businesses and homeowners and students and consumers who pay. Our witnesses, their organizations, have developed a narrow and consistent solution that protects small businesses and families with mortgages and Americans paying off student loans. I look forward to hearing from our witnesses, to working with my colleagues to protect consumers and protect the economy. We've proven we can come together in this committee. We try to do it often. We succeed sometimes to find areas of agreement and to advance common sense solutions for the people whom we serve. My hope is we can do the same on LIBOR. Senator Toomey.
Thank you, Mr. Chairman, and welcome, and thank you to our witnesses today. LIBOR, the London Interbank Offered Rate, has long been the most widely used U.S. dollar-denominated benchmark interest rate across all kinds of financial contracts. In 2013, the G20 launched a global review of interest rate benchmarks after cases of misconduct in the reporting of LIBOR rates by a small number of banks and the significant decline in interbank lending volumes. As the breadth and depth of the interbank loan deposit market greatly diminished, it became clear that alternative rates with greater volume and a larger number of market participants would be more appropriate than LIBOR. In the United States, the Federal Reserve Board and the New York Fed convened the Alternative Reference Rates Committee, or ARC, to identify an alternative to LIBOR. In 2017, the ARC identified the Secured Overnight Financing Rate, or SOFR, as its recommended alternative. SOFR measures the cost of overnight or short-term borrowings collateralized by U.S. Treasury securities. Last year, the Fed, the FDIC, and OCC directed banks to stop entering into new LIBOR contracts as soon as possible and no later than the end of this year. The administrator of LIBOR will stop publishing all LIBOR settings by June 30th of 2023. And although most existing contracts referencing LIBOR will have matured by that date, a number of contracts will not, and some lack the fallback language to replace LIBOR with a non-LIBOR index. As a result, many have called for federal legislation to address these so-called tough legacy contracts. Now, I agree that banks should stop writing new LIBOR contracts as soon as it's practical, and federal legislation is likely needed to address these tough legacy contracts. The unique and anomalous circumstances related to the Libor transition probably require action by Congress to amend contracts between private parties. But such congressional action should be a last resort. As we consider this measure, any legislation that addresses these tough legacy contracts should be narrowly tailored, should not change the equities of these contracts, and they certainly should not affect any new contracts. In July, the House Financial Services Committee approved a bill that would replace LIBOR in these legacy contracts with a Fed-selected SOFR-based benchmark. The bill takes a reasonable approach, and the Senate should carefully review it. In so doing, we should consider targeted amendments such as ensuring that qualified non-SOFR benchmark rates are not disfavored in future contracts. So while it's appropriate to mandate a SOFR-based index for this relatively small universe of tough legacy contracts, for new contracts, banks should have the option to choose among qualified benchmark rates, including credit-sensitive rates, to the extent that they're appropriate for their business models. Risk-free rates like SOFR may work well for some derivatives contracts and for some institutions active in the Treasury repo market, but may not be well suited for loans or certain community or regional banks. The funding costs for such banks typically increase relative to SOFR during periods of stress, which could create an asset-liability mismatch if loans were required to reference only SOFR. The Fed, the FDIC, and the OCC have previously acknowledged this dynamic. They have said the use of SOFR is voluntary, and a bank may use, and I quote, any reference rate for its loans that the bank determines to be appropriate for its funding model and customer needs, end quote. An even broader group of regulators said in the context of bank lending that, I quote, supervisors will not criticize firms solely for using a reference rate or rates other than SOFR, end rate. I think that's very important, which is why I'm concerned that this may be what the Biden administration financial regulators are actually not pursuing. Just last week, the acting controller of the currency said the OCC's supervisory efforts will, quote, initially focus on non-SOFR rates, end quote, which suggests to me that the OCC may apply heightened supervisory scrutiny to non-SOFR rates. And last month, a senior New York Fed official said that banks that use a non-SOFR rate must do, quote, extra work, end quote, to ensure that the bank is, quote, demonstrably making a responsible decision, end quote. The SEC chairman, Gary Gensler, has been even more explicit. On multiple occasions, he's criticized one particular credit-sensitive rate. So these statements raise concerns that some regulators, are pressing all banks to use SOFR without any transparency or public input. It seems to me if a bank wants to price its loans off a rate it believes is a better reflection of its cost of funding or its customer needs than SOFR, then regulators should not prohibit the bank from doing so. Now, this pressure, however, pales in comparison to the preferred approach of President Biden's proposed nominee to lead the OCC. Professor Saul Saleh Omarova has written that widely used benchmark rates should either be pre-approved by the government or worse, subject to, quote, utility-style regulation, end quote. In other words, the government, not the market, would have a direct role in actually setting benchmark rates as it deems appropriate. This is just one example of the many radical ideas that Professor Omarova has proposed that demonstrate a clear aversion for democratic capitalism and a clear preference for an administrative state where economic and market decisions are made by technocrats who think they know more than the market. Regulators should never disfavor qualified rates, and banks should have the choice to use any rate that meets well-established criteria for benchmark rates. I hope to hear from today's witnesses about the transition from LIBOR, the potential for targeted federal legislation to address these tough legacy contracts, and ways to preserve benchmark rate choice. Thank you, Mr. Chairman.
Thank you, Senator. Hang on. I'll introduce today's witnesses. Mr. Thomas Whiff serves as chair of the Alternative Reference Rates Committee, which was convened by the Federal Reserve Board to help ensure a successful transition from LIBOR to a more modest reference rate. He's a program. Mr. Whiff is a managing director at Morgan Stanley. Mr. Andrew Pizer, staff attorney in the National Consumer Law Center's Washington office, where he works on issues related to mortgage financing and defending homeowners from foreclosures. He served as an expert witness on mortgage origination and servicing issues. The Honorable Christopher Giancarlo is a senior counsel at Wilkie Farr and Gallagher, previous chair of the Commodity Futures Trading Commission. Often saw him in Agriculture Committee, sometimes here. In that role, he oversaw regulation of the futures options and swaps derivatives market. He's testified often about financial and derivatives markets before Congress and into the EU Parliament. Mr. Michael Bright, also no stranger here, is Chief Executive Officer of the Structured Finance Association. He was Executive Vice President and COO of Government National Mortgage Association, Ginnie Mae. He was a director at the Milken Institute Center for Financial Markets, and we first worked with him when he worked in the office of Senator Robert Corker. Mr. Whiff, please begin. You're recognized for 5 minutes.
Thank you. Chairman Brown, Ranking Member Toomey, and members of the committee. I'm honored to be here today on behalf of the Alternative Reference Rate Committee, the ARC, to testify on the need for federal legislation to address U.S. dollar LIBOR transition for legacy products and support the efforts of the committee to bring that to fruition. The ARC is comprised of both a diverse set of private sector firms and associations representing a wide range of perspectives on the LIBOR transition, as well as a broad set of U.S. agencies, including the Federal Reserve, the CFTC, the SEC, Treasury, the OCC, the FDIC, and the FHFA, who observe our work. We were convened by the Federal Reserve Board and the Federal Reserve Bank of New York in 2014 in order to help address the financial stability risks that the Financial Stability Oversight Council had publicly identified concerning the use of LIBOR in the financial system. ARC working groups have involved thousands of participants across more than 300 different institutions, including lenders, borrowers, investors, and consumer advocacy groups. The ARC has estimated that U.S. dollar LIBOR is referenced in over 200 trillion notional financial contracts alone, and that roughly a third of these contracts will remain outstanding as of June 30, 2023, when LIBOR will cease. The ARC was convened to help facilitate a smooth transition and was asked to identify a robust alternative to U.S. dollar LIBOR, one that was appropriate to base trillions of dollars of contracts on and to address risks to legacy LIBOR contracts. The ARC selected the Secured Overnight Financing Rate, or SOFR, which is the U.S. Treasury repo market, as its recommended alternative based on the fact that it is by far the most robust alternative to LIBOR available. There will always be a U.S. Treasury repo market, both in good times and bad, and based on the widespread support from a broad range of market participants, including end users and borrowers, we now expect that many market participants will choose to use SOFR, and many have already done so or are actively preparing to do so. However, we also support choice. And we have been clear since our inception that our recommendations are voluntary. At the end of the day, the market will determine which rates are used in the future. For many existing legacy contracts that reference LIBOR, however, things are much less simple. Many legacy non-financial corporate contracts referencing LIBOR have no fallback language whatsoever. Many financial contracts have fallbacks that would require parties to poll an unnamed set of banks in an attempt to recreate LIBOR, which we believe would be both burdensome and unsuccessful. Others refer only to the last published value of LIBOR, effectively converting what were floating rate instruments into fixed rate instruments. These contracts are difficult or impossible to change in the absence of a legislative solution. Without legislation, parties to these tough legacy contracts will face significant operational and market disruptions, contractual disputes, and economic hardship. To help address this risk to these tough legacy contracts, the ARC developed and promoted legislation for contracts governed by New York law to avoid the disruptions, market uncertainties, and confusion that would otherwise occur when LIBOR ends. The passage of state legislation in New York and subsequently also in Alabama has been extraordinarily important, helping to address the risks of the LIBOR transition. In particular, many financial contracts are covered under New York law. However, we know that many non-financial corporate contracts, consumer loans, and securitizations are not covered. So while the ARC is prepared to advocate for similar legislation in other states, we cannot reasonably hope for comparable legislative solutions in all 50 states and the District of Columbia. Federal legislation can help to ensure an equal outcome for all Americans. The legislative proposal before your committee would help to ensure that equal outcome. As with legislation already passed in New York and Alabama, the legislative proposal is purposefully narrow, intended only to address the contracts that cannot otherwise be changed. For contracts that already allow one party the right to choose a new rate, a feature of most consumer contracts referencing LIBOR, the proposed legislation does not alter the right of the designated party to determine the successor rate. But the legislation does provide safe harbor to encourage a choice based on SOFR, which has had the strong support of consumer advocacy groups in addition to lenders and investors. And this is intended to help ensure that consumers are treated fairly in this transition. For contracts that have no fallback language or language that only refers to a pool of banks or some past value of LIBOR, the proposed legislation recognizes that a unique successor rate must be named in order to avoid legal conflict. We believe that this form of tailored legislation is appropriate and necessary to avoid disruption to the economy. We support the legislative proposal before your committee, are grateful for your consideration of it, and on behalf of the ARC, I thank you.
Thank you, Mr. Pizer. You're recognized for 5 minutes. Thank you for joining us.
Chairman Brown, Senator Toomey, and members of the committee, we thank you for the opportunity to testify today on the importance of protecting consumers from potentially higher loan costs that could be triggered when the benchmark LIBOR index ends. I provide my testimony here today on behalf of NCLC's low-income clients. My primary message is to encourage the Senate to support H.R. 4616, but with an essential change, a more limited safe harbor. With this change, H.R. 4616 will protect both consumers and the credit industry from possibly devastating consequences from the transition away from the LIBOR. The LIBOR is used to adjust the rate on more than $1 trillion of consumer mortgages, student loans, and other credit contracts. When the LIBOR ends in less than 2 years, the credit industry must substitute a new index. If the transition is not done correctly, the resulting higher loan payments could force millions of consumers into default and lead to widespread litigation against industry. The typical adjustable rate loan allows the creditor broad discretion to choose a replacement index, but there is no exact replacement for the LIBOR. So without clear legal protections, both consumers and industry could be at risk. Consumers from higher payments that could trigger defaults, and industry from lost profits and litigation. Additionally, some contracts require other adjustments when a new index is used. These adjustments are called conforming changes because they bring the contract into conformity with the replacement index. However, there is no consensus on how to determine what these conforming changes are or their legality. Based on our experience with predatory lending and problems in the loan servicing industry, we're concerned that some companies may abuse or mismanage their discretion by trying to gouge consumers. Now, there are several possible scenarios for how this could happen. Our biggest fear is that the lender could pick a replacement index that unfairly increases the loan payments. Under the guise of conforming changes, A lender might change the method for calculating payments or the margin used to set the interest rate. Consumers have no control over this process. If harmed, their only recourse will be to sue. Because this issue affects such a broad range of the economy, industry participants, government regulators, and consumer groups have been meeting to discuss possible solutions. These meetings have produced a consensus that the best replacement for the LIBOR is the SOFR. But these groups can't force anyone to use it, and it's not clear how many companies will voluntarily adopt it for legacy contracts. We understand that note holders are delaying this decision because of concern over litigation risk. Currently, the House is considering H.R. 4616. This bill includes several provisions that deal with replacing the LIBOR. For consumers, the single most important creates a safe harbor for note holders that voluntarily use the appropriate version of the SOFR to replace the LIBOR. The current bill includes broad immunity from lawsuits when SOFR is selected and the related conforming changes are made. We support the concept of a safe harbor, but the current language is just too broad and could allow bad actors to escape responsibility even when they hurt consumers. Now, we've discussed this problem with industry, and we have agreed on some adjustments to the safe harbor language that would enable us to support it. My written testimony has the details on this point. But overall, it's very important for Congress to adopt legislation that encourages note holders to use the SOFR in legacy contracts when the LIBOR ends. This is important enough that we are actually supporting creating a safe harbor for note holders, something we wouldn't normally do. But it is equally important that the safe harbor be narrowly tailored so it's not abused. I want to conclude by thanking industry, the members of this committee, and the House committee for working with us to find a solution that helps everyone. And I'm happy to answer any questions you may have. Thank you.
Thank you, Mr. Giancarlo. You're recognized for 5 minutes. Thank you for joining us.
There we go. Chairman Brown, Ranking Member Toomey, members of the committee, thank you very much. It's good to be before you once again. I'm Chris Giancarlo, Senior Counsel at Wilkie Farr & Gallagher. I'm the former chairman of the CFTC, an agency that has led and continues to lead the transition away from LIBOR. I'm also an independent director of the American Financial Exchange. I have extensive experience, both as a market regulator and as a business executive, with financial benchmarks, and particularly with LIBOR. During my 5 years at the CFTC, I traveled across the country to meet with Americans and businesses who depend on futures markets to hedge the prices of products and commodities they produce. I walked factory floors in Illinois, pecan farms in Georgia, grain elevators in Montana, feedlots in Kansas, and power plants in Ohio. I went 900 feet underground in a Kentucky coal mine, 90 feet in the air in a North Dakota natural gas rig, and flew 900 feet in the air in an Arkansas crop duster. Almost all of the small and medium-sized businesses that I met were supported by America's community, minority, and regional banks. I support open and competitive U.S. markets, but my comments today are frankly less about the need for competition, but more about choice of complementary benchmarks. America's trading markets feature a diverse set of pricing benchmarks serving different needs. In our grain futures markets, there are multiple pricing benchmarks, including Chicago soft red winter wheat, Kansas City hard red winter wheat, and Minneapolis hard red spring wheat. The different benchmarks serve to establish the cost of different varieties of wheat used in different bread products. Pizza dough, for example, is made from different wheat than breakfast cereals. In our oil markets, there are also different benchmarks, West Texas Intermediate and Brent crude oil, again setting distinct prices for different fuel products, like domestic auto gas or industrial oil. And of course, in our equity markets, there are multiple benchmarks, like the Dow Jones Industrials, the S&P 500, and the Russell 2000, to measure the different performance of large multinationals compared to early-stage growth companies. Such variety of specifically designed benchmarks allows market participants to make choices that are right for their investment needs rather than a one-size-fits-all approach. Choice of benchmarks is a reason why U.S. futures and equity markets are the envy of the world. Strangely, one U.S. market that has not had a similar range of choice of benchmarks is bank lending, where LIBOR has been dominant for decades. In fact, the ubiquity of LIBOR in American commercial lending is one of the reasons why ending it presents such a potential crisis today. Lack of choice of benchmark is itself a systemic risk. The United States banking industry is unlike any other in the world. On one hand, our large money center and Wall Street investment banks lead the world in global trading, investment banking, and large project finance. But on the other hand, our community, our minority, and our regional banks spread out across the urban, suburban, and rural landscape finance the everyday needs of America's consumers, small and medium-sized businesses, minority communities, and domestic job creators. A banking industry that is so varied, so complex, and so essential to our economy needs the diversity and durability that comes from choice of interest rate benchmark. A one-size-fits-all approach would be a source of systemic risk to the U.S. economy. As we move away from LIBOR, we must be clear that lending institutions, be they large money center banks or local, regional, or MDI banks, should have the flexibility to choose amongst appropriate benchmark alternatives that meet their customer needs. I urge you to consider legislation ensuring that America's community lenders have the ability to choose among sound and properly qualified benchmark replacements that meet the international standards based upon robust markets with transparent price discovery. Having choice among multiple qualified benchmarks not only facilitates the transition away from LIBOR, but it also enhances efficiency, reduces systemic risk, and encourages economic growth for generations to come. Thank you.
Thank you. Mr. Bright, welcome to the committee. You're recognized for 5 minutes.
Chairman Brown, Ranking Member Toomey, and other members of the committee, my name is Michael Bright, CEO of the Structured Finance Association, or SFA. On behalf of the member companies of SFA, I thank you for inviting me to testify. I also thank you for your focus on finalizing the transition away from LIBOR for millions of consumers and investors. The Structured Finance Association is a consensus-driven trade association with over 370 institutional members. SFA members include issuers and investors, data and analytic firms, law firms, servicers, accounting firms, and trustees. Importantly, our investor firms are fiduciaries to their clients. Unlike some trade associations, before we take any advocacy position, our governance requires us to achieve consensus rather than a simple majority. Let me first make abundantly clear that many of SFA member companies were impacted by the LIBOR scandal. We need to ensure that this never happens again. Contracts based on a floating rate index must be able to rely on the integrity of that index. This is a critical component of the work SFA is engaged in today. The cessation of LIBOR has been an enormous challenge overhanging the capital markets since 2017. At that time, the Financial Conduct Authority, LIBOR's regulator based in London, announced that the production of LIBOR would likely end in 2021. Over the subsequent years, extensive progress has been made to move away from these rates. Today, out of over $200 trillion of contracts that are tied to LIBOR in the U.S., nearly all have managed to put in place a plan for transition. Even with this multi-year effort, however, SFA estimates that roughly $16 trillion of contracts have no realistic means to be renegotiated and amended. These so-called tough legacy contracts were made prior to knowing that LIBOR was going away. These include mortgages, student loans, and business loans, and therefore impact a broad range of American households and communities. $16 trillion is a large sum, posing serious risk to the financial system. After lengthy deliberation and debate, a consensus position across the entire market has emerged that a federal safe harbor for the transition of these tough legacy contracts is the only option to avoid costly litigation and consumer disruption. The many other alternatives examined simply did not work. We now see that, absent federal legislation to provide a safe harbor, retirees and savers will be forced to absorb tens of billions of dollars in legal costs. But legislation can offer a solution. A tailored safe harbor can provide certainty for all parties in a LIBOR contract. If done properly, SFA believes that legislation will respect some important principles. For one, legislation to address LIBOR should not create any value transfer among contractual parties. The safe harbor should be as narrow as possible. Legislation should not impact choices of rates for new contracts, but should instead focus solely on legacy contracts. And finally, legislation should not disrupt contracts that have adequate fallback language in them already. With these principles in mind, SFA is strongly supportive of the bill that recently passed out of the House Financial Services Committee. Simultaneously, on behalf of the entire membership of SFA, I specifically want to thank Senators Tester and Tillis for the leadership they are providing on this issue in the Senate. We are here to provide any assistance that you all need. Timing is critical. While market participants are working tirelessly to transition contracts that allow it, loans in tough legacy contracts are in limbo. Rulemaking by the Fed takes time, as will implementation of those rules. So while the formal date for the end of most LIBOR contracts is now mid-2023, most LIBOR rates, the problems and the legal costs begin much sooner. In conclusion, let me thank you all again for your focus on helping to move our markets away from LIBOR once and for all. This work is critical to ensuring that all investors, consumers, and businesses are treated fairly. It also will help to prevent billions of dollars of potential litigation where no one wins but savers and retirees foot the bill. Thank you, and I look forward to answering any questions that you have.
Thank you, Mr. Bright. All of you obviously have been essential in your work on the Libor transition. I'd like to ask each of you, and I'll start with Mr. Whiff, to concisely and briefly just tell us why it's important to have federal legislation to deal with the problematic legacy loans and contracts. Mr. Whiff.
Thank you, Senator. As it relates to tough legacy, as we work through this, there are going to be many, many contracts that will be amended bilaterally by market participants. As we get down to the most challenging contracts or the tough legacy, it's critical that we have legislation to the extent that it will help smooth that over, and as has been mentioned here, minimize value transfer and present a fair, effective, and clear approach. And that clarity to reduce uncertainty for those borrowers and lenders in those contracts will be critical. And I think time is of the essence because we're really in a position now where, absent a solution, many of those note holders and others may have to take action away from that. So our goal really here is to present that fair, effective, and clear solution to those toughest legacy contracts, which really is one of the final pieces of this transition puzzle and will help us close the book on this.
Mr. Pizer.
Thank you. We're concerned that the industry is just paralyzed by litigation risk at this point. They need some clarity because they're worried that no matter what index they choose, they're going to be sued. If it goes, if payments go up or if payments go down, consumers and investors will be affected. So our first choice would be that Congress require use of the SOFR in legacy contracts. But we understand that's not going to happen. So we think a safe harbor will be a good inducement to choose the SOFR. It'll eliminate the litigation risk. And we're confident that it's been carefully vetted, that it is the closest to the LIBOR. Congress needs to do this because there just isn't time for all 50 states to do it. And that will provide the clear guidance, clear playing field for legacy contracts to move forward until they're terminated.
Thank you, Mr. Giancarlo.
Yeah, quite briefly, it's about moving away from a benchmark that's deeply ingrained in the U.S. economy and has been for 4 or 5 decades now, underlines so much of what we do from the consumer level all the way up to our large institutions, and to do so in a way to move away from this with the minimum amount of adverse impact on our economy, legal costs, legal uncertainty, economic costs. So it's about clarity, legal certainty, and reducing the trauma to the economy of this transition.
Mr. Bright.
Yeah, echoing everything everyone here has said, without legislation, contractual parties are going to seek court guidance on what rates to use. And if they do that, consumers will get different rates. There may be disparate treatment there. And also importantly, that costs a lot of money, tens of billions of dollars. We estimate those costs flow down through to the investor, which is often savers, retirees. And so it's just court costs that we should avoid.
Thank you. Mr. Pizer, you mentioned the discussions among consumer and industry groups on consensus language to further tailor the legislation to better protect consumers. Give me your thoughts on why that's important, benefiting borrowers and lenders.
I'm sorry, I didn't hear you quite.
Well, why those changes protecting consumers are important and why they would benefit borrowers and lenders.
Well, there are certain expectations that all the parties have had going into these contracts. And again, I just want to emphasize we're focusing on the legacy contracts. People had expectations about what the LIBOR would do, what their rates would be like in the future. And so it's appropriate that whatever index replaces that should be as close as possible to the LIBOR to match those expectations, and that will be the SOFR. Now, we're willing to go to support a safe harbor to encourage companies to do this, but it needs to be properly tailored so the safe harbor only encourages selection of the SOFR and making appropriate conforming changes. We don't want bad actors to see this as an opportunity to encourage some extra transfer of value. The current language in the House bill, we're concerned, is so broad that it would allow bad actors to escape liability for taking an opportunity to gouge consumers. But we think we've agreed with industry on some substitute language that will meet everyone's needs. It'll give a safe harbor for doing the proper conforming changes, for choosing the SOFR, but it won't allow people to run amok. And we think it's a very viable option.
Okay, thank you. Mr. Whiff, last question. LIBOR won't be published until June 2023, as you know. You and ARC and other stakeholders have indicated it's important for Congress to act soon, even though that's 2 years away. Mr. Bright said timing is critical just a moment ago. What will that lead time allow for? Is there a risk of acting too slowly?
Yes, I think there is. We've seen, I think our history in the New York legislation gives us a sense that builds a lot of confidence. So as market participants, see these outcomes taking place and they see progress on these legislative paths, that gives comfort to the market and I think allows good market functioning while these things take place. But we're in a pretty, short time zone with 18 months after the end of this year that, you think about investors that hold these securities, borrowers and lenders who don't have the ability to amend these contracts may have to take other action, whether that be, and we want to reduce the, the prospect of fire sale on these securities. We want to reduce the prospect of, litigation as we get there. But the goal really is to provide that confidence to the market that we're moving down a path. And I think that certainly the New York State legislation showed us that can be helpful. So I think we're in a pretty tight shot clock right now.
Thank you. Thank you all. Senator Toomey.
Thanks, Mr. Chairman. For Chairman Giancarlo, in your testimony, you talked about two fatal flaws that required and led to the transition of LIBOR. One was the shallowness of liquidity, by which I think you were referring to a thin trading volume. The other was the narrowness of liquidity, as you put it, by which I think you meant a small number of banks that would participate in establishing LIBOR. So it seems that a problem with inadequate liquidity is that the rate that's determined might not accurately reflect actual borrowing and lending costs, and therein lies the problem. So could you help explain for us how it is that SOFR, Ameribor, and maybe other alternative rates avoid these pitfalls? Why is the shallowness and narrowness of liquidity not a problem in these other rates?
Thank you, Senator Toomey. Both at my 5 years at the CFTC, but also the decade and a half I spent before that as a senior executive of a firm that actually managed marketplaces for market makers, one of the largest marketplaces for a range of sophisticated financial products called swaps and others. So I've spent a lot of part of my professional career considering the challenge of liquidity in trading markets. And there's a phrase called the liquidity puzzle that people that are active in marketplaces understand. Liquidity is never one number or one feature. There's a number of facets that go into liquidity. And LIBOR suffered from a failure in at least two of the most important facets, and that is that the trading volume was actually quite shallow. In a number of the tenors of LIBOR, there's less than a dozen trades a day. But another factor was the limited number of actually participants in that market, a half dozen or so Wall Street banks. So there's a lot that goes into healthy liquidity. As we talked about, depth is one, breadth and diversity of market participants is another. Concentration is another. Is the liquidity provision concentrated amongst a small number of firms? And then there's a question of access to the liquidity. Is the liquidity available to all participants? And if so, at what cost? Are there different cost factors for some participants? And then finally, dynamics. Under what market conditions does that liquidity diminish or does it expand?
And just briefly, do these other indices, are they clearly superior in all of these aspects of liquidity to LIBOR?
Indeed. I think a lot of the qualified benchmarks that we're talking about today address a lot of the shortcomings of LIBOR, but address it in different